Hello, everyone, and welcome to Wise Credit Management. This is the start, Lesson 1. I want you in this lesson to be able to understand the system that we have. The system itself is very complicated, and it's not something that you should just walk into thinking that you're going to know everything about. That's why I wanted to start with a kind of a base and show you guys some of the inside things that you need to know before you get started. So with that being said, let's take a short preview of Lesson 1. First thing I want you guys to know is that bad credit is expensive. I'm going to take you through a scenario in which we kind of lay out how much bad credit can cost you. Increased rent or mortgage, $300, increased car payment, $100 a month, increased auto insurance. Did you know that your auto insurance can actually, the premiums that you pay can actually be affected by your credit scores? And you could also wind up having to come out of pocket with thousands of dollars in additional deposits when you go to rent a house or an additional down payment on a car. So all of that can wind up costing you. It can add up to $500 a month or more. That's how expensive bad credit can be for you. We're also going to talk about the lending system, and we're going to talk about risk, and we're going to talk about how risk affects interest rates. We're also going to talk about how certain things are not factors in your credit score. I want all of my students to be able to understand that while there are problems with the credit scoring system, the credit scoring system itself does not take into account things like race, gender, where you live, how much money you have in the bank. I want all of you to understand that you can get a good credit score if you understand the system and how things work. And we're going to talk about a wise path to wealth. Now, that's my, I'll say, personal invention for graduates. In other words, when you've taken all of the lessons and you go through the graduation lesson on the website, you'll have access to certain advanced classes, including Wise Path to Wealth. We start basically with a couple. They start with nothing, including a little bit of bad credit. We take them through the process where they buy their first home, then they buy their second home, then they buy their third home. All of a sudden, they're real estate investors. And by the time it's all said and done with, they are doing very well. So I want you guys to have a preview of that lesson in Lesson 1, just so that you know how important having a good credit score can be. And with all that having been said, let's get started. And hey, if this is your first time joining us, we're so happy to have you here. This is just a short introduction and a review of the Essentials class. We have several pretty simple goals for the class. Mainly, I want you to understand the principles of wise credit management. My name is Jason Johnson, and while I was an active real estate professional, I focused on first-time homebuyers, many of whom needed help with their credit. Then one day, I believe that God put it on my heart to develop the program that I wish existed for people with credit problems. I know this class isn't the most entertaining, but I believe that it will be the most informative for you. It's completely free to students. It's the most comprehensive program that I know of, and if you pay attention and learn the material, you will be able to build and maintain a good credit score to help you accomplish your goals. I want you to learn how credit really works while being simple and avoiding too much complicated math. It's wisdom that works in the real world. All views expressed are my own and from my experience as a former mortgage professional. Just like your accounting professor won't do your taxes for you, I can teach you how the credit system works, but I can't help you with your credit. On the other hand, what if you do need a professional to help you out? Well, we do have members that can help you. Most real estate professionals can't, or rather shouldn't, try to help you out with your credit because it's just not what they do. You don't really need to understand something as complicated as credit algorithms. You just need to know someone who can understand it. If you need help with getting a good credit score or buying a home, we have a directory of professionals who are ready, willing, and able to help. The directory also has many other types of professionals who you might need along the way. I'm not endorsing any specific company or service, but if that person lists their company on this website, you know they're willing to help you on your journey. And if you don't want to call professionals one by one to explain your situation and see if they can help, you can go to wisecreditprofessionals.com and write one time about the details of your situation, then sit back and let up to 3 of our Wise Credit professionals contact you about how they can help. I show you a lot of screenshots of other companies' websites so that you can see where the information that I get comes from, but the class is considered a new work for education and commentary purposes and therefore does not violate copyright law. Many of the screenshots that I use are directly from the company that calculates your FICO credit score and from the big 3 credit bureaus. We do offer affiliate links, and I would appreciate if you use them, but I also strongly encourage you to use the affiliate links of the other members. When you open accounts with one of these companies, you'll get your own affiliate links offering either cash payments or statement credit, which could add up to over $1,000. And you can see how easy it is to forward the link to this class as well as your own affiliate links to anyone who might need this class. And if you want to see what new opportunities are available since I created this video, you can go to the homepage and click on Options and Opportunities for you. This is where you can find our directory to local professionals and not just someone on the phone offering you a rate they can't actually give you. And you can also find affiliate links to other companies that can help you along your journey. Guys, who wishes I would talk just a little bit faster and make the videos just a little bit shorter? Well, I can. Just go to your settings and adjust the playback speed. Guys, thank you so much, and with all that having been said, let's begin. We get so much good advice from Proverbs. Every prudent man acts with knowledge, but a fool lays open his folly. You know, it's so easy to make mistakes when you don't know the system and how things really work. In lesson 1, we're going to take you through and explain some of the things that you need to know, and also I'm going to introduce you to maybe not necessarily the actual people, but we'll say the professional titles of the people who are going to be able to help you out. One of the important concepts that I keep referring to during this class is the idea of the wealth gap. Now, wealth is basically the ownership of appreciating assets, things like houses, and people who own appreciating assets are on the right side of the wealth gap. And really, the wealth gap separates the haves from the have-nots. How do you get on the right side of the wealth gap? The first and, in my opinion, the most important step is home ownership. 80% of self-made millionaires are real estate investors. Real estate is a tried and true way to help people get from being, we'll say, young and poor, frankly, to having the ability to build wealth. It takes time, but you can become a self-made millionaire through real estate. The basic concept is that when you buy a house using debt, you lock in the exact amount that you owe on that house and then start paying that amount down over time. However, the house appreciates. In other words, it becomes more valuable over time. Historically, on average, houses appreciate about 3% per year. Well, what does that mean? We're talking about per $100,000 of value. Now, I know that in different parts of the country, maybe you could still buy a house or a mobile home for $100,000, but realistically, 200, 300, 400,000, however much your first home costs in your region. We are just using this as an example per $100,000 valuation. So for every $100,000 your first house is worth, generally you're going to get a 3% appreciation per year. Now, the house might not go up that much, or it might go up significantly more the first year, the first few years, but on average, $3,000, $6,000, $9,000, $12,000 is what you're going to add to the house's value per $100,000 valuation. And you're only going to have a mortgage balance of we'll say less than 96,500. Now, why would I use this particular figure? This represents a 3.5% down payment. Usually, first-time home buyers start with something along the lines of an FHA mortgage, which requires you to put 3.5% down. So per $100,000, your mortgage balance is going to be about 96,500. But let me explain it to you this way. When you owe 96,500 and you're paying it down, but your house is worth 100,000 and going up in value, that creates a gap right here. That gap is what could be referred to as a net worth, or specifically equity in your home. So that's where we get all of this. All this money in between here and here as your house goes up in value is money that you didn't have before, and you really didn't have to work for it. All you had to do was own an appreciating asset. Let's say that you wound up owning this house for the full 30 years. Most houses you buy, your mortgage is going to be 30 years long. Let's say that you owned this house for the full 30 years and you got this house paid off. Per $100,000 in value, how much would that house be worth in 30 years at 3% appreciation? What we do is we go to something called a website called investor.gov. I use different websites that you can go to. You can look these up on your own, and I specifically point out exactly which website it is. This one, you can enter in all the factors. Per $100,000, 3% per year compounded over 30 years winds up adding up to almost $250,000 in value per $100,000 of value that you bought your house for. Now that's over a 30-year time frame. Now, most houses here in the US, I think on average, the starting home buyer is going to be looking at about a $300,000 valuation. Well, if you own, or if you try to buy a $300,000 house using that 3.5% down, you will have to come out of pocket with about $10,500. Now, if your house does appreciate at 3% per year, that would be about $9,000 per year and leave you with a loan balance of $289,500. So you can see very quickly how that $9,000 a year winds up adding up. Now we're starting to talk about some real numbers. So you can see how all of this works together to get you on the right side of the wealth gap. Let me ask you one more question about this. Say that you did buy this $300,000 house and it appreciated at $9,000 per year, well, 3% per year compounded. So not exactly $9,000 per year, but what would the amount of the house be if you held on to it for the full 30-year term and wound up paying that house off? According to investor.gov, per $300,000 valuation at about $9,000 per year. Now, this amount goes up as you compound the value. So don't let this deceive you. It actually becomes more over time. But in 30 years, this $300,000 house would be over $700,000. Now you can kind of see how things start adding up. Now you can start thinking to yourself, well, gee, what if I bought my first house and when it was time to buy a bigger house, I just rented out my first house. Now you can start to see how you can use real estate to build a net worth and to get on the path to wealth. So that's what I wanted to show all of you guys to start with, how these numbers can actually add up over time. Now you understand what I'm talking about when I say the wealth gap. Imagine if you owned this house versus renting all of your life. One of the things that I like to address in this class specifically are facts versus myths. You can call me a mythbuster. I don't know if that's copyrighted or anything. Basically, what myths wind up having a habit of doing is when you've always heard something or everyone always says, myths have a habit of becoming accepted as facts. In Psalms, it teaches us, keep your tongue from evil and your lips from speaking deceit. In other words, it's important to tell the truth. Well, one of the biggest myths, or actually three of the biggest myths out there that I hear a lot, especially from younger first-time home buyers, they think you need great credit, they think you need a large down payment, and they also think that no one is out there to help them. Well, let's talk about each of those specifically. You need great credit, you need a large down payment. Let's find out. This is a very basic overview of the different mortgage programs available. First of all, VA. For those of you in the military, you know that that stands for Veterans Affairs. It's a VA loan specifically for our veterans. And by the way, thank you so much for serving if you are a veteran. The VA loan itself, one of its biggest selling points is it's a zero down payment. It requires zero down payment. So do you really need a big down payment? No. We're going to talk more about this later on, but really what you need is a few months of reserves for unexpected expenses, things like that. Let's also talk about this. Now, a 620 credit score, they really want you to have a little bit higher than that. 620, for those of you who already know a little bit about credit scoring, that's not all that high. So VA is a very good program if you're a veteran and if you're qualified for that. What about conventional loans? These are the loans that most of us mere mortals are required to get. The 620, maybe not required, but these are usually the ones that are better for us. 620 credit score, again, similar to VA. Usually they like to see you with a 700 for lower private mortgage insurance, and we're going to talk about that at length in lesson 10 and how to handle all of that. But usually you wind up having to have about a 3% down payment for a conventional loan program. USDA. For those of you who are out in guys, forgive me, I always have a hard time, and I acknowledge that I have a hard time saying rural. I grew up on a ranch. I can say pretty much any R word with no problem, but rural is difficult for me. This is for rural development, and it provides home loans for people who live in lower population density areas. So in other words, outside of major cities. What's the main selling point for USDA loans? Again, 0% or $0 down. Really what they like to see, just like VA, is that you have a few months worth of mortgage payments in a savings account after you close. So that's really important to the USDA and getting approved. And USDA likes you to have over 640 credit score. So slightly higher there. Like we talked about, FHA. FHA is going to be something that we discuss quite a bit in this class. Past bad credit is acceptable. 3.5% down, and that down payment can come from nonprofit assistance. So what are some more details about this FHA loan? Popular among first-time we are using FHA.gov, so we're getting information directly from the source. It's popular from a first-time home buyer's point of view. It requires strict inspection and appraisal. You have to be buying a pretty good house. It has to be in good shape. Now, there are rehab loans available through FHA, but I'm not going to cover those at length. FHA is really for houses that are already in good livable condition, and FHA is the most forgiving on credit history. Well, what about down payments? Again, we're using specific websites. This is HUD.gov. HUD oversees the FHA program. Well, down here at the bottom, we see between credit scores between 500 and 579. In fact, I'm going to come over here and just talk about the highlights. 500 and 579. Those of you who already know something about credit scoring, this is pretty easy for anyone to attain. This is limited to a maximum loan to value of 90%. In other words, they'll lend you up to 90% of the value of the house. Where does the other 10% come from? Usually that's going to come from you. So this, even if you have bad credit, if you can come up with 10% down, you can probably buy a house through FHA. Well, if you have a little bit over 580 credit score, you're eligible for maximum financing, a loan to value of 96.5. To put it in a different way, you are eligible for a 3.5% down payment. So 580 and above is really what you're shooting for. Now, hopefully you can get quite a bit higher than that, and this course is going to teach you how to do that. But back to our facts and myths. The myths that I think I just dispelled for you are that you do not need good credit and you do not need a large down payment. So Those are the facts of the matter. So we've discussed those. What about the idea that no one's out there to help you? I remember back when I was first starting, when I bought my first house, there are some really basic things that I wish I had known back then, and I'm going to discuss with you right now. Let's start off talking about mortgage loan officers. One thing that I want you guys to understand is that loan officers are out there to help you get approved for a mortgage. They are the ones that sit down and talk to you, interview you, get all the facts of your situation, and create your application for you. It's their job to put your best foot forward to help you get approved. Most loan officers are paid at closing. So really, they don't make any money unless your loan is approved and you are able to buy a home. So they don't get paid until you become a homeowner. And one more thing that I want to mention is that banks, while they're wonderful institutions, they are not always the best option to go to. Sometimes mortgage companies, sometimes what are called mortgage brokers, are the better professionals to go to get a mortgage and to get approved for a mortgage. So once you're approved for a mortgage, next you need to find a real estate agent. Usually you're going to want to find a buyer's agent. And one tip that I want to give you guys is that not all real estate agents want to work with first-time home buyers. There's a lot to it, but basically it's a little bit more work, and a lot of times, especially older, more experienced real estate agents already have clients who are buying, we'll say, slightly higher income level properties, and the deals usually go through a little bit smoother. So they wind up making more with less work. But if you're a young real estate agent just starting out, you are going to work with a lot of first-time home buyers, and you're going to represent first-time home buyers trying to buy their first house. Those are the people that I want my students to think about using. Buyers agents out there that are going to be a part of Wise Credit Management, they work for you. They're willing to help you go through the entire process to become homeowners. They understand your needs, and they are going to be the people that you want to work with. Choose a good buyer's agent that understands your circumstances and is willing to work hard for you. Now, there are two different types of insurance that I want to cover. Property insurance is basically just like it sounds. If something happens to the house, the insurance contract will make you whole. And there is a yearly premium, but it's divided up into monthly payments and added into your mortgage payment. We're going to talk more about escrows in Lesson 10. The next type of insurance and insurance agent that I really want to talk to you about is a life and health insurance agent. Now, they can be the same person that does your home insurance, but especially if you're self-employed, you would benefit from having health insurance. But if you're buying a house, life insurance, especially if you're married and your spouse would need help in the event of your passing, you're in a situation where your family is relying on your income, you definitely need life insurance. At the very least, buy a life insurance policy that'll help cover your salary at least for a few years after you pass, and hopefully you can get a life insurance policy that'll pay off your house if something happens to you. So don't leave your family homeless, desperate, needy just because of a very difficult event that happened to you. We're going to talk a lot more about credit counselors, but really what credit counselors can do for you, they can help you with your budgeting, and they can help you set up a debt management plan, which will help you catch up on any past due bills as long as they're not already in collections. If you are in a bad place, feel free to talk to a credit counselor and see if they can help you. Credit repair organizations, also known as credit repair companies, are usually for profit. They usually charge about $100 a month for their services. The people who work in this industry usually have a background in personal finance. They usually have a separate business entity, and they're usually required to have a surety bond. All of that depends on your state's laws, but most importantly, they thoroughly understand state and federal laws regarding debt and credit reporting, so they can help you get things that shouldn't be on your credit report taken taken off. They can also help you negotiate to get the balance on collection accounts reduced to the point that you can afford them. Consumer protection attorneys, or what could be called a FCRA lawyer. We're going to talk a lot more about this in lesson 8. But consumer protection attorneys specialize in credit law. They can help you with disputing. They can sue under the Fair Credit Reporting Act. They can also help you with debt negotiation and debt settlement. So basically, they're an actual lawyer as opposed to a credit repair organization. They can actually help you sue for your rights. And there are also bankruptcy attorneys. Sometimes they're the same as FCRA attorneys, other times it's a completely different person. But when we talk about bankruptcy, I want us to refer to it as bankruptcy protection. There are two different types of bankruptcy. Chapter 13, which allows you to keep your assets, stop foreclosure or repossession. Your attorney and a court trustee will help you work with your creditors to work out a debt repayment plan. It will require a strict budget and require that you make all of your payments on time, and you must get approval before obtaining any new debt. On the other hand, Chapter 7 bankruptcy protection wipes away all of your unsecured debts. On the other hand, your secured debts stay, so you keep making the payments on things like your car, your mortgage, your student loans, but all of your unsecured debts are gone. And we're going to talk more about bankruptcy in lesson 8. But I wanted you guys to understand one thing from the start, that you can qualify to buy a home using FHA 2 years after you discharge from Chapter 7, and you can also qualify for conventional financing in 3 years. So guys, if you ever get into a situation where you need to file bankruptcy, just understand that it takes 2, 3, 4, 5 years to get yourself back to a place where you can get restarted, buy a home, and move on. If you're in a situation where you can't work your way out within 2, 3, 4, 5 years, bankruptcy is probably the best way for you to go. So if you do file bankruptcy, reestablish your credit, watch lesson 4, and keep going. Remember, joy cometh in the morning. We'll talk more about that later on. Investment professionals called certified financial planners. These are people who are experts at helping you track your retirement and investments and plan for that. 401k rollovers, self-employment IRAs, Roth IRAs, all of those things are wonderful retirement vehicles and ways to invest and save for retirement. But one thing that we do talk about, all of those are also potential sources for down payment. And I want you guys to be willing to talk to a certified financial planner about the possibility of using any of those as a source for your down payment before you start cashing out any kind of 401k or retirement accounts. Always talk to a certified financial planner about what's possible and what's realistic and what the best way for you to go is. But these are good ways to find a source for a down payment. And I know that it may seem out of place when we're talking about and we're focused on home ownership, but I really have a pet peeve about cars and auto financing. A lot of times the people that I used to work with had a expensive car that they were having to make payments on. That's a burden, and it is something that is going to weigh you down when you go to qualify for a house. We'll talk more about that in lesson 10, but just remember, when you're trying to buy a house, try not to buy a new vehicle. If you've got paid off vehicles, that's wonderful. You're already in a great spot. But if you need to buy a car before you buy a house, try to buy the least expensive, reliable vehicle that you can find, and try to finance it in a way that it can be paid off in 3 years or less. I tried to put together a group of auto finance and auto sales professionals who understand what we're trying to do, that a house is more important than your next car. And we're going to talk more about the idea of the golden nugget later on. But guys, these professionals who are members of Wise Credit Management will help you find your golden nugget. So I've shown you the facts versus the myths. The facts are that you don't need great credit to own a home. You don't need a large down payment. And there are people that are members of our program, Wise Credit Professionals, who are out there and willing to help you on your path to homeownership. Next, we're going to talk about the system itself. We're going to talk about lenders, borrowers, credit, and interest rates. Lenders are obviously places like banks, mortgage companies, and credit cards. And borrowers are the people who get loans to buy whatever it is they need or they want. The types of loans that most people get are for home loans, what we call mortgages, auto loans, credit cards, student loans, etc. So lenders take money from either investors, or if you're a bank, you take money from depositors who expect profits in return. So investors expect profits, depositors expect interest rates. Well, where are they going to get those interest rates? The bank lends their money out to other people in exchange for dun, 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 an interest rate. That's where banks make their money, is the middleman. Well, banks have to decide which applications to approve and which ones not to approve. They also have to decide what interest rate to charge. Now, different lenders charge different interest rates, and usually those interest rates are based on two main factors. It's not always this simple, but I try to oversimplify things in this class. Number one, they charge interest rates based on their desired profit margin, and they charge interest rates based on your risk premium. Well, what's desired profit? So for-profit companies seek to maximize profits by offering the highest competitive interest rate. In other words, the highest rate you're willing to pay in order to pay their investors. And not-for-profit organizations are like credit unions. They are designed specifically to serve their members. And I encourage everyone of my students to join a credit union. And you can see over here, I've got a gentleman in fatigues. You know, I was raised Army. If you can get over the Navy part, Navy Federal Credit Union is one of the best places that I can think of if you're in the military to join. But I strongly encourage everyone to join a credit union. There are organizations specifically for teachers. They are specifically for just members of a specific community. So there are places that you can go to join a credit union and see what options they have for you, because sometimes credit unions have very good opportunities for mortgages that are not covered in this class. So I want to mention that and encourage everyone to at least talk to a credit union and find out what they can do for you. So we talked about desired profit. What about risk premium? Now that is, and again, we use very simplified examples here. For the purposes of this class, risk premium compensates for the expectation of some people defaulting on debt. And again, an oversimplified example here, but I'm going to call it the 99 percentile. So let's say that you lend the same amount of money to 100 people and only 99 of them pay you back. Well, you have to charge these 99 people a certain amount to make up for the one person who didn't pay you back. How much is that? Well, if you do the math, it winds up being a little bit over 1%. So you have to add on a little bit over 1% to these 99 people to make up for the one person who didn't pay you back. Well, in lesson 2, we've got the 90 percentile. So let's say that you lend the same amount of money to 100 people and only 90 of them pay you back. Well, you have to charge these 90 people an additional over 11% interest to make up for the 10% of people, or the 10 people who didn't repay you. So that's where risk premium comes in. And that's a dramatically oversimplified version of how pricing risk works. So back to our 99% example, let's just say that there's a desired profit margin of 10%, and you have to add in 1% risk premium to these 99% of people who are going to pay you back. Well, if you add the 10% and the 1 point something percent, you wind up with 11 point something percent interest rate. So that's how pricing works in an oversimplified example. And I keep saying oversimplified for a reason. It doesn't really work quite this way, and it's not quite this simple. But that gives you an idea of how lenders price things when they really do expect that people are going to pay you back. There's always that one person that comes up with some kind of trouble. And our 90% example, now there are 10% of people who cause trouble. Remember, you're still going to want to make this 10% return, but now you have to add in this 11% just to make up for the 10 people who didn't pay you back. So 10% as a desired return on investment, and 11% of risk premium equals 21% interest rate. So that's where it becomes very important to figure out whether somebody is in the 90th percentile or the 99th percentile. And we get this from Experian.com. Now, Experian is one of the credit reporting bureaus. So, what they say is specifically a credit score is designed to predict your likelihood of falling at least 90 days behind on a bill within the next 2 years. So, that's what credit scores are designed to do. And we can see from this graph here that credit scores of less than 600 have a 27.6% likelihood of falling 60 days or more behind on newly booked real estate loans, in other words, mortgages, within the first 24 months. So if you have under 600 credit score, you've got a 27% chance of falling behind. Well, what about 600 to 640? 18.4%. Okay, remember that I had talked about a lot of loans like you to have 640 or better. That puts you in this 11% category, which is right about what I was talking about with the 90th percentile. So this is kind of the sweet spot that lenders look for this and above, because above that you can get a pretty accurate estimate of who or how many people are going to go into default, all the way up here to a high of 800 to 850. This should say 850 over here. But the highest credit score bracket is a 0.7% chance of going into default. So that gives you an idea of why people, or of why lenders use credit scores to determine risk based on an arbitrary score. I know that a lot of people find difficulty with assigning an arbitrary score, but they are predictive in terms of who is going to fall behind on a mortgage or on any kind of debt within the next 2 years, who's going to fall 60 to 90 days behind. Lenders need a way to determine who's going to be in the 90th percent group and who's going to be in the 99th percentile. Well, who does that? Introducing FICO, the Fair Isaac Company. Basically, what FICO does is look at your credit report and use an algorithm to create a score based on the information that's on your credit report. It was created, the FICO company was created by William Fair and Earl Isaac in 1989. Basically, what they do is they sell the score that they created to lenders when you apply for a loan. And one thing that I want you to know is that 90% of all lending decisions, in other words, the industry standard, are affected by the FICO score. And one thing that I also want you to know is that it's available to you. In other words, you can purchase your own FICO score at myfico.com. So that's something that you need to know, and we're going to be referring to this slide over and over throughout the classes. But one thing that I do want you to know is that you can get your mortgage FICO scores on this website. Now, they are called the 2, 4, and 5 version. We're going to cover credit scores in great detail. In fact, by lesson 3, you guys are going to be close to expert level knowledge in terms of FICO scores. But the thing is, just starting out, if you don't ever see another lesson but this one, know that you can go and buy your mortgage FICO scores and know exactly what the lender is going to see. So kind of the way that I phrase it is, I think it costs $29 to see your complete 3 bureau package one time, and then you can cancel that. So it costs $30. So it's like a pre-application fee. Just think of it that way. Credit reports, and again, this website is myfico.com. So this is the actual company that makes your credit scores. Basically, what they want you to know is that lenders report your borrowing history, and past behavior indicates future behavior. Credit reports show kind of like a snapshot of all of your accounts, whether they're current or not, whether you've maxed out all your credit cards, things like that, that are going to give a lender basically a quick snapshot of where you are with your credit. It's kind of like taking your vital signs. It gives someone an idea of what's going on with you. So like we said, lenders need a fast way to separate the 90th percentile from the 99th, and credit scores use statistics to determine the probability that you'll pay loans back. Just like we talked about before, the people who have over 800 credit score are something like a 1%, a 0.7% chance that they're going to fall behind, as opposed to a 27% chance that someone with a lower than 600 credit score will go into default on that particular loan. Well, statistics can be wrong. And one thing that I want everyone to understand is that having no credit score whatsoever puts you in about the 90th percentile. But one error on your credit report can give you a bad score. In other words, if you don't have anything on your credit report other than one error, that can give you a bad score. So you thought that you had no score, you thought that you were cruising through with no credit, but a error that was put on your credit report that you, through no fault of your own, that winds up giving you a bad score. And it's time for another myth buster. I've always heard, everyone always says, somehow that becomes a fact when it's just not. Well, remember, keep your lips from speaking deceit. A lot of people and a lot of my students are going to have it in their hearts that the system won't work for me. The system's racist, whatever your reason is, age or any number of factors, including where you live. I heard one time, I hesitate to mention it, but I'm going to. A gentleman was on a radio show and trying to explain that credit scores take into account your SATs. I wanted to slap him through the radio. No, they don't take anything like that into account. In fact, the 1974 Equal Credit Opportunity Act is a federal law prohibiting discrimination. In other words, credit scores don't use certain factors, including race, color, religion, national origin, sex, marital status, age, receipt of public assistance, or good faith exercise of any rights under the Consumer Protection Act. So I want everyone to understand that credit scores and whether or not you are lent to, in other words, a lending decision, cannot be based on any of these factors. And nobody even thought to include SAT scores in this particular list. But I've been doing this all of my professional life. No one ever uses SAT scores. Also, the Equal Credit Opportunity Act requires creditors to provide a reason for denial. And MyFICO, the people that created the FICO score, go even further. In addition to race and gender, geography, if you feel like you're in a red line district, nobody's going to lend to me in this particular neighborhood, that kind of thing, that's not included in your credit score. Also, your bank account balance. When I first started, I remember thinking it was a little bit surprising that you've got money in the bank, so why won't they lend to you? Well, A bank account balance does not factor into your FICO score, so no one outside of your actual bank knows how much money you have in the bank. All of that is a long way around to me articulating to you that anyone can get good scores if they understand and work inside the system. And Experian goes on to say scores do not consider employment status, income, age, race, gender, where you live, etc. So we've got the federal law, which says it's illegal. We've got the credit scoring company, the company that makes your credit scores, saying no, we don't include that. And we've got a credit bureau saying no, that's not included. I wanted to make sure from three different sources, I wanted to show you guys that things like this are not included. In this class, I'm going to be very blunt with you and also honest and show you where I get all of my information. I openly acknowledge that there is a difference in the average credit score among races, but those are caused by socioeconomic issues. They're caused by income indisparity. They're caused by any number of factors that don't have anything to do with the scoring algorithm. So I want you to know that if you pay your bills on time, if you manage your credit wisely, you can have a credit score. And I'm talking, obviously, I'm on a video right now. I don't know who you are, but as long as you are, let's just say, an American citizen with a social security number, you have access to our credit system, whatever your circumstances are, just make sure that there's good information on your credit report and you can have a good score. Now, one thing in addition that I wanted to mention, my professional members, there is absolutely no discrimination on race, on gender. I created a picture and I tried to create an environment that represents this. There's a wide diversity among mortgage professionals, real estate professionals, insurance professionals. So if you have a concept, a preconceived notion that a lender is more likely to lend to you if they're of the same race or color or background, then what I tried to do is put together on my website the ability to choose which professional you work with based on their picture. So the professionals that put pictures on their profiles that list themselves as willing to help you on Wise Credit Management, those guys, you can choose who you work with. And frankly, you can tell who is who by their picture. Or at least you can have that opportunity to choose for yourself. But as a professional, I am telling you that no one is allowed to discriminate based on all of those factors. Okay, back to the concept of the wealth gap. I wanted to take a few minutes and cover the idea that there is a cost to having bad credit. It costs in terms of housing, transportation, insurance, basic quality of life. Someone who is anonymous, and we think that based on my research, I think that it was Mark Twain. The quote is, "A fine is a tax for doing something wrong. A tax is a fine for doing something right." Well, in my eyes, high interest rates are basically a fine on people who don't have good credit. It creates a barrier to financial success and home ownership, and it's something that we can fix. Like I said, it affects your housing. If you're going out to rent a house or an apartment, a lot of times you need a 600 credit score. What a lot of people don't know is that sometimes landlord's mortgage or insurance company can actually require minimum credit scores for their tenants. And frankly, a high credit score can be a compensating factor if there's something in your past that you're hoping a landlord would overlook. If you've got a high credit score, that can cause a lot of things to be overlooked. Continuing with the idea of creating more expensive housing, if you go to own a home, higher credit scores equal lower interest rates. So if you have a below 640 credit score, you're likely to have a 1.5% higher interest rate on your mortgage. Even if you do get approved, you're likely to have a much higher interest rate. In fact, on our typical $300,000 loan, you're likely to pay up to $300 or more per month in interest just because you have a worse credit score. When it comes to transportation, lower credit scores oftentimes make transportation more expensive. You can get rates up to 25% on poor quality cars, what we would call a junker, that also have high repair rates or high repair costs. So cars can be more expensive for you. And some states allow, in fact, most states allow for what's called predictive analytics to be used for insurance premiums. Well, credit what that means is that insurance companies can use credit-based insurance scores in order to calculate your insurance premium. So higher credit scores have a lower chance of filing a claim. I know that sounds crazy, but there are studies that we're going to go through in the advanced lesson on insurance credit scores and the the LexisNexis report. However, none of this should affect your life or health insurance. So make sure and get life and health insurance whether or not you've got good credit. And finally, according to Credit Karma, you can also have to put down higher deposits. If you rent a house or apartment, you might need a higher deposit. Utilities, higher down payments on auto loans or mortgages. All of that can wind up adding up to a $300 a month or more increase in your mortgage, a increased car payment, think of those 25% loans, increased auto insurance. They can actually, like I said, they can use your credit scores to determine your insurance premiums. They can increase the deposit requirement for renting a property. So all of that can total $500 a month or more. Having bad credit creates basically what I refer to as fines. It's more expensive to have bad credit. And when it's more expensive to live, it's more difficult to save up money for down payment. It's more difficult to live without debt. Homeownership becomes more difficult. Obviously, I'm older now, but I do remember what it's like to start out, and I've seen a lot of people basically go through periods of feast and famine. Things are good or things are bad. It's dangerous out there when you're living paycheck to paycheck. Now, I use the example of storms, but basically a financial storm could be losing your job, it could be a medical problem, it could be a car repair, but storms and floods happen. The way that I see good credit is like a life jacket, an emergency fund. Basically, you're hoping it doesn't get that bad to use a credit card to live on, to buy groceries, to fix your car, whatever it is. Good credit can actually be, like I said, like an emergency fund, like a life jacket to get you out of a difficult situation. Hopefully, over time, you're able to get your situation stabilized. You're able to move up away from the floods and the difficulties more into safety and stability, especially when you're thinking about having children. You're thinking about owning a home for the first time. You're thinking about a steady job, health benefits. This class was specifically designed to help you know what you're doing and follow a path that will lead to a better financial future for yourself and your family. Here in lesson 1, we just got done discussing bad credit fines. We're about to discuss goals, vision, a path forward, steps. In fact, step by step for building credit is going to be in lesson 4. But one thing that I wanted to show, wouldn't it be nice if every path was this straight and you could see exactly where you're going while you're walking there? Well, in the real world, it's not always that easy. In fact, look at this. Goodness, if you're starting down here, you can't even really see the path, to say nothing of having a straight line from one place to another. And believe me, these paths can get way off. You can get off track very quickly, which is why you're taking this class to understand how the system really works. In lessons 2 and 3, we're going to cover your credit report and credit scoring. Like I said before, and by the end of lesson 3, you're going to understand credit scoring very, very well. That way, instead of a winding, jerking path, it's going to look more like something that you can easily follow. Now, there's still going to be good and bad situations. There's still going to be different routes that you can take, but you're going to be able to see where you're going and where you're trying to go. So lessons 4 and 5 are building credit and how to get the best possible credit score for you. Now, we talk about an 850 credit score in lesson 5, but really I'm using that to show you exactly how you can use the same principles to get the best credit score that you can get at this time before you apply for a mortgage. In lesson 6, we talk about what happens when there is a flood and how to recover. So I walk a couple through the path of having to spend too much money on credit cards, having to buy a truck basically on an emergency, to have high interest rates, and we walk them through a systematic way to pay off debt, which will also keep their credit scores getting higher. So I focus lesson 6 on how to maintain your credit score and help your credit score get better along the path of recovery from a difficult situation. In lesson 7 and 8, we're going to talk about credit repair, credit counseling, and bankruptcy. So basically, lesson 7 and 8 are the first times that you will need help, or at least you'll have the opportunity to go get help from someone if you need it. And guys, if you're in a bad situation, don't be afraid to reach out for help. In lesson 9, identity theft. I know that fist punch has nothing to do with credit right up until you've had your identity stolen. Believe me, I know, I've been there. It feels like someone punched you in the face. So what happens when someone else caused you to go through difficulty? Things like identity theft. I'm going to take you through, I didn't know at the time, so I had to learn this for myself. I'm going to take you through step by step how to recover, and we're also going to talk about specifically how you can lock your files and keep other people from being able to use your accounts fraudulently. And then lesson 10, which is focused on getting approved for a mortgage. Homeownership, the biggest first step. It's like we talked about on the path to wealth, the biggest first step. Well, just imagine if your step was like this. And I know that this is a little bit unrealistic, but I remember the first time that I went out to buy a house. I was a lot younger than normal, but I still remember what it felt like to go out, and frankly, I didn't have my parents. I didn't have anyone really to guide me on this particular path. So I was operating without a net, and I remember how scary it was and how apprehensive I was. It really can feel like you're trying to jump off of one cliff and onto another. Well, wouldn't it be nice if there was a bridge down there that you could just walk across? Well, guess what? Guys, the way that I see it, professionals actually provide that bridge. I am trying to, with this program, not only teach you the best ways to handle your credit, but also provide you with the best professionals that I can get a hold of to join the program, to teach, and to be willing to serve you on your path. So remember, professionals bridge the gap to getting across the wealth gap. I believe that it's important to have goals, to know where you're trying to go. Your path, the steps, the right direction to take are all something that you need to sit down and think about diligently before you get started. Some of your goals from a high level can include home ownership, low debt, and having a proverbial life jacket, an emergency savings or emergency credit. In the Wise Path to Wealth, in the advanced lessons after you graduate, we take you through a scenario where you can start from nothing, become a first-time home buyer, all the way to being a real estate investor and owning multiple properties. So that puts you on the Wise Path to Wealth. I teach the class from the point of view of do it yourself, without any inheritance, without family loans, without pre-existing knowledge. So Basically, I'm taking you from a place where you don't really know anything to the point that you can actually own multiple properties. And the point is to get you ready for opportunities. You never know when God is going to bless you with the chance to buy a property below market value. I know that over here in these pictures you might see a mess, but to me, I see properties that are probably priced well below market value, and for good reason. But if you know how to put the work in, you can actually turn those into opportunities, and they'll be blessings for yourself and your family. You never know when you're going to come across a situation where the owner wants out, whether it's needing rehab. The couple could be going through a divorce. It could be an estate sale. They could need to do a quick sale. You never know when somebody's going to get a great job opportunity, but it's across the country and they need to sell their house now. Well, hey, if you're ready to buy a house now, that'll give you the opportunity to take advantage of that situation and benefit yourself and your family. So we focus on getting into a good financial position to purchase, having low debt, a high credit score, 3.5% or more ready on a down payment, and like we talked about, reserves, which is also considered a rainy day fund. And now I'm going to cover a few tips that you guys are going to want to know as you start your journey. First things first, FICO scores are used by 90% of lenders. Now, Vantage scores, we're going to talk about that more in lesson 3, but places like Credit Karma and a lot of the free apps use what's called a Vantage score. Basically, it is a credit score, but it is not used in most lending decisions. Also, one thing that I want to point out is that these scores that you can get off Credit Karma are usually 30 points higher than FICO scores. And frankly, that's not just my opinion. I'm going to show you exactly where that's where that's coming from. And like we talked about before, to rent a house, most landlords want to see at least a 600 credit score. So that's a pretty good goal to start out with. Usually, automated underwriting systems, and we're going to talk a lot more about that, especially in lesson 10. Automated underwriting systems to approve you usually want to have a 640 or higher credit score. Luke 16:10 tells us, "He who is faithful in what is least is also faithful in much." In other words, start small. Prove that you can handle something, what is least. That'll prove that you can also handle something that's, well, in this case, much. So if you start with small loans, you can work your way up to a mortgage. In lesson 4, I'm going to show you how to use that principle to create a credit report that has 2 term loans and 3 credit cards. That'll wind up giving you, in about a year, a 700 FICO score, which is average for the United States. So start small, 2 term loans and 3 credit cards, and it's easy to do. There's a step-by-step system for doing it. So guys, none of this is difficult. Start small, build from there. Another thing that I wanted to mention, loans with under 10 months of payments left help your FICO scores and maybe I should put in there, could increase the maximum loan approval amount for a mortgage. Now we're going to get into that in more detail in lesson 10, but one thing that I want to emphasize, please try not to buy a new car before you go out and apply for a mortgage. Another good goal is to keep your credit cards under 5% of their maximum limit. So you want to minimize the amount of credit usage that you have. Like we talked about, credit cards can be a life jacket in a time of crisis. In an unforeseen event, you'll be able to recover without missing mortgage payments, car payments. You'll be able to put food on your table. If your car breaks down, usually mechanics will be able to take a credit card. Things like that can keep a flood, which is bad enough in the first place, from being a financial disaster. And remember, like we talked about, Auto insurance companies sometimes give discounts to people with higher scores, so life is less expensive when you've got good credit. If you have made mistakes, we're going to teach you how to recover from those. We're going to teach you how to build good credit despite having mistakes on your credit report. And we're going to teach you how to guard your good credit. And when you practice wise credit management principles and have low debt, if any debt, it makes it a lot easier to save money for down payment and reserves. So having low debt actually makes it easier to own a home and to save for the down payment. And in our graduation lesson, I give you basically a bonus lesson: automobiles, the bane of the mortgage world. Guys, if you're in financial difficulty, or like I keep saying, and I emphasize this, if you're about to apply for a mortgage, please don't buy a new car. Only own the minimum amount of car that you can get by with. Don't spend money on prestige and ego when you need that money to pay off debt so that you can buy a home. Now remember, this is Jason talking, and the Jason brain sometimes works a little bit differently than most other people. But the way that I see it, a reliable, let's just say a 10-year-old car, costs about $5,000. Now, 36 months of payments at any interest rate, even if it's that terrible 25%, that's better than a $50,000 car plus the insurance that goes with a $50,000 car, even if it's at 0% for 84 months or however long they're going to lend you that money to repay that car. Guys, please keep your payments as low as possible. Get that car paid off, even if this $5,000 loan is at 20% interest. That winds up being, now the math isn't exact, but $500 a month will get this car paid off in a year. Then you've got a nice little compact car with no payments on it. So you'll be set. The way that I like to put it to my students: which would you rather have? A new car in front of your apartment or an old car in front of your home? And finally, we're introduced to the Golden Nugget. Guys, this is the actual car that I drive. Now, it certainly wasn't my first choice, and there's a long story behind it, but basically, when I came up to Dallas, I had a old Chevy truck, and it wasn't the most reliable thing. Well, I decided that I was going to get kind of a throwaway car, and I'd always wanted something that was smaller and compact, and I kind of figured, you know what, a little Nissan Altima, those things are known for reliability, and, if it breaks down, it's $2,000. I think I spent right at $2,000 for it. And over the next few months, I spent about $1,000 getting little things repaired on it, including new tires and suspension, things like that you have to have on an older car. But let's just say that within the first year, I spent about $3,000 on that car. I wind up putting away $100 a month in maintenance and insurance costs. I don't remember exactly. I've got pretty good insurance, $100 a month. So I've got a cash car, no payment, $100 a month in maintenance, and $100 a month in insurance, and it's pretty good on gas. That's the kind of car that you want to own if you want to go ahead and become a homeowner. So if you ever see a little, and I know it's not exactly gold, I don't even understand what color that is, but if you want to own a home, buy a very inexpensive car. And if you ever think to yourself, hey, I'm above that, just remember, guys, frankly, I can afford to buy, within reason, any car that I want or truck. And, I choose to own this car. I'll explain it to you in the graduation lesson and later on. But the fact is that this car saves me enough money that I've actually gotten kind of fond of it. And I made it the class mascot, the Golden Nugget. So guys, if I can drive this old, ugly Nissan Altima around, you can drive something that's a little old and a little ugly, get it paid off, and go become a homeowner. Now it's worth mentioning that Proverbs, King Solomon tells us 4 different times the rough equivalent of Plans succeed through knowledge and wise counsel. Guys, let's make a plan and let's stick to it. Well, how do you make a plan? Goals, plans, whatever you want to call it. I like to call them SMART goals. Now, I'm not the person who invented this. This isn't my acronym, but it's something that I think you guys should keep in mind. SMART goals are S, specific, M for measurable, A for achievable. In other words, how are you going to get there? R is for relevant. There has to be a why you're trying to do this. And T is for time bound. In other words, when. An example of your SMART goals might be specific, knowledge to build good credit; measurable, get approved for a mortgage; achievable, well, how are you going to achieve this? Learn the essentials of credit. Maybe I should put, and implement them. You have to learn it, then do it. Relevant, in other words, start your path to wealth. So get started. And time bound, well, that's really dependent on your situation. Some of you might know exactly what you're doing and where you're going and want to find out the basics of mortgages. Other people might be in a very difficult situation, and financially, a lot of times it takes a great deal of time to rebuild yourself after that. So, time really is situation dependent. Some very basic goals for good credit are high credit scores, low debt, and home ownership. Now, in this class, I created several, and we'll call them classmates. This is obviously a stock photo. I called her Rebecca. We created a situation, a scenario. Now, our situation for this woman, Rebecca, is that she's an 18-year-old college student. She wants a reliable car and an apartment sometime soon, and she has no credit right now, and she feels lost. So think about, if you're 18 years old and just starting out, Rebecca is the situation, the scenario that I want you to pay attention to. We're going to take her through her first few accounts, building her up to, within 6 months, having a pretty good credit score, and within a year, having about a 700 credit score. She is not going to be lost for long. So let's talk about some SMART goals for Rebecca. Good credit, a 700 mortgage middle score. Achievable, she's got to start building credit. That's the how. Relevant, well, she wants better options in life. She wants to be a homeowner. She wants to build wealth. And time bound, she wants to do all of this before she graduates from whatever program she's going through, maybe nursing or something like that. Before she graduates, she wants to be in a good credit situation so that she can rent her own apartment, get a nice car, and have a pretty good start to life. I also created a couple, a scenario. Curtis and Angela, they want to buy a home, but they've got a high debt burden. Their credit score is in the mid 600s. That's pretty low when it comes to wanting to buy a home. And they feel hopeful. They are taking this class to learn exactly how to deal with whatever it is they're going through and come out stronger and more capable of owning a home. Well, what are some SMART goals for Curtis and Angela? To increase their credit score, to go from the 600s to the 700s. How are they going to do it? Well, they're going to pay down their debt, and we're going to show you how to do that in lesson 6. They want to become successful homeowners, and they're not really sure how long it's going to take. Now, Charlie. Charlie's my guy. I gave this guy as many difficult things as I could think of. He's currently going through a divorce, or maybe he just got divorced. He's got a medical situation going on. He lost his job. He's behind on his bills. His credit score might be 500 or so. This poor guy feels overwhelmed and he wants his life back. If you're in that situation, if you're in a great difficulty, if you're in pain, guys, remember one thing, and I really try to emphasize this in this class, that bad credit is not terminal. We're going to show you how to recover from whatever situation you're going to or going through. Remember Psalm 30:5. Weeping may endure for a night, but joy comes in the morning. So, what are some things that Charlie needs to be focused on? Well, he needs to handle whatever situation that he's going through. That isn't really something that we can cover in this class, but really sometimes your goal needs to be see the next sunrise. Do whatever is possible to get you through this situation. Remember, a lot of times in this world and in this life, we develop strength by struggling. Sometimes you have to go through the fire. And time bound, I'll give you a little hint. Mr. Charlie is going to take advantage of our bankruptcy system. It's going to take him a few years to recover from that, but you know what? He's going to come out stronger. So if you're out there and you're really going through great difficulty, we're going to take you through that, okay? Just remember, joy cometh in the morning. Well, what about you? What is bad credit costing you? Remember, you can get better rates on loans or insurance if you have good credit. It takes time. Well, how is all this relevant? Well, you want lower payments. You want things to cost less, right? And you also want to get approved, presumably for a mortgage. And time bound, goodness, 30 days to 7 years, it could take as long as it takes for your situation. And you know I really take this verse to heart. Sometimes God provides people to help you when you really need it. Our professional members participate in wise credit management to serve you by doing what they do best. And remember, you can watch these videos online, but you should also find a local meeting to come and share your difficulties and also your successes. Remember, we celebrate success. I tried to make it easy to find local groups and local professionals on wisecreditmanagement.com. Back when I was younger and just starting out, in fact, it was before I became a real estate professional, I found a house that was a really good deal, so I put it under contract. It was being sold by a couple that was getting a divorce and it needed a lot of rehab work. It was a really great deal, and I had a pretty big down payment. So I went down to my bank and they actually said no. And the guy who turned me down was actually kind of rude about it. Luckily, I didn't give up and I found a different bank who would do the loan for me. But while I was building this class, I decided I wanted to make it a lot easier for you to find somebody who can help you. All you need to do is type in some details about your situation, and you can have up to 3 professionals contact you about how they can help you. So, whatever your situation is, maybe you've got a rehab that you want to do, maybe you want to get an FHA loan, but you've got bad credit. Whatever it is, you can enter some details about your situation, and we'll help you find a wise credit professional to help get you approved. Well, what if you want to find a great deal like I found, but you're not sure how to go about doing that? Well, what you need is a buyer's agent. What you should do is enter in what you're looking for, and we'll help you find a local real estate agent that can help you find the deal that you need. Just type it in, and we'll help you find a professional that'll work for you. And of course, you need insurance, but really what you want is the best coverage on your home for yourself and your family. And guys, don't be like our friend Charlie and have a major health problem without life and health insurance. Especially if you're buying a home and you have a family, please contact an agent to get yourself proper coverage. And guys, if you have to make major decisions about your retirement account, especially if you're going to withdraw money for the down payment, please talk to a certified financial planner. Also, if you're a freelancer or some type of gig worker, please contact someone about getting a Roth or a self-employed retirement program started. And guys, if you're behind on any of your bills, maybe late fees are being added onto your account, maybe you're considering bankruptcy, please contact a certified credit counselor about a debt management plan to see if you qualify for Chapter 7 or if you need to prevent foreclosure or automobile repossession. It's time to talk to a bankruptcy attorney. On the other hand, consumer protection attorneys specialize in the Fair Credit Reporting Act and suing for violations, so they can actually wind up getting you money out of these companies that are harassing you. And credit repair organizations can help you by professionally disputing bad debt. Many of them are former or even current mortgage professionals who know the laws on disputing and how to get things removed from your credit report. And finally, if you need a reliable and inexpensive car like our class mascot, the Golden Nugget, then you should contact one of our dealers who can help you find what you need. Well, what's your homework for lesson one? Guys, in this class, I emphasize documenting things. Write stuff down in a journal. Know how each action affects your progress. If you're like me, you can always create a spreadsheet for tracking how different things affect your credit scores. If you are dealing with bad debt, and especially things like collections, you want to create a file, anything to save correspondence, legal documents. So you want to keep all of that in one place. Really, what we're trying to do here is to create your own success story. Guys, are you paying bad credit fines right now? Are you missing any opportunities? Did you see a house that was a really good deal and you wish that you had 700 credit to buy it? So, what are your goals? And remember, write those goals down. Write down, what is bad credit costing you? Well, what scores do you need? And we're going to talk more about that later on. What's your utilization ratio? Current versus desired. We're going to talk about that later on. How much money do you spend on credit card debt and loan payments every month? And what's your next step? Now, what I like to do is tell people to dedicate $100 a month to reducing their debt wisely. That's in lesson 6. But guys, if you're in a bad place, make a commitment to yourself to put at least $100 a month toward toward getting out of whatever it is you're going through, whether it's turning off your cable, whether it's not buying cookies and ice cream. That's my personal thing. Guys, I'm a little bit overweight because I like to eat cookies and ice cream, but if I wouldn't get those, that would get me right at halfway toward that $100 a month. So, sometimes you got to give yourself a treat, but put $100 a month toward what you're doing. That's going to reinforce how much you care about what you're trying to do. In Wise Credit Management, we celebrate success, and I emphasize we. We have a community. We have Facebook, we have, if you're on LinkedIn, the Twitter, X, guy, I'm not even sure exactly what it's supposed to be called, but YouTube, we are trying to create a community where on social media and especially on wisecreditmanagement.com, where we have different groups set up to help you get where you're trying to go, for updates, to share success, and to encourage people. Remember, your situation could encourage other people. You can create your own testimonial to help other people get where they're trying to go. And speaking of helping other people get where they're trying to go, everyone knows how to forward a web page by now. Please, if you know anyone who needs this, text them the website or email it to them or post it on social media. Guys, we're trying to get the word out that this class is free and it's here to help people. Success is overcoming. Guys, focus on your goals and not your obstacles. To overcome, we talk about getting started, we talk about developing goals, and we specifically try to apply the knowledge and the wisdom that we gain here to solve whatever problems you're going through. Lesson 2 is how to read and understand your credit report. A quick preview of lesson 2 is that we're going to take you through how to get your credit report for free, how to set up credit monitoring for free, how to get your mortgage FICO scores for $30, like we talked about already. And remember that I focus on mortgage scores, not necessarily other versions of FICO or Vantage Score. I mentioned FICO 8 because it is important in building your credit, but things like Vantage Score and any other company's credit scoring systems, those aren't specifically relevant because we're focused on mortgage scores and specifically the FICO 2, 4, and 5 models. So, guys, it's been a long lesson. Thank you so much for sticking with me to the end. I hope to see you in lesson 2. Like I said, we're going to talk about reading and understanding your credit report. We're going to have a specific example for you, and it's going to get you one step closer to your goals. Guys, thank you so much, and I can't wait to see you in lesson 2, and God bless you on your journey.